Insurance companies have a duty to their insureds to be profitable. That sounds a little strange. So an insurance company has a duty to profit off of the people they write the insurance product to. Why would that be? Well, if an insured and if an insurance company doesn't exist, then and the ability to withstand a bad day is not there, then the insuree is left holding the bag of a particular loss. So an insurance company absolutely needs to profit off of its insurance policies. In order to evaluate if it's profitable, an insurance company will look at these three ratios. The loss ratio. The loss ratio would be the percentage of insurers' earned income used up by the reserves and claim payments. Okay, so this is how the losses that are coming in, that the reserves, so the extra premiums that have been collected are going towards these losses. It's the true product provided by the insurance company. So you have a claim on a bad day, the insurance makes it a good day. Why is it a good day? You have your house built up, you have a new car, you have your medical bills paid. This is simplifying things, obviously, but that is how the insurance companies makes do on its promise, and this is its loss ratio. Next would be its expense ratio. So this would be the percentage of insurance companies' income used to pay the underwriting expenses. So when you have a house that you want to give to the insurance company as a risk, then there's an underwriter that needs to look at the house, say, oh, that tree is too close, let's cut those branches. Why does the underwriter care about this? Well, because the insurance company has provided the underwriter, we are okay with this set of risks. We want to take more risk that looks like this. And if this risk doesn't look like this, we're not going to write the policy. There are several policies along the coastline of Texas where my insurance company says, I don't want your wind because a hurricane will come out, wipe out the entire neighborhood, and we will go bankrupt. So we don't write wind on those particular houses. Fire, we'll take. Flood insurance, well, that's something else. But property damage, we'll take. But when it comes to specific wind damage, where you say you could go somewhere else because we don't want that type of risk. The ability to make that decision has an expense because there's people behind the desks doing the research. I'm part of my company's expense ratio, so that's my salary is paid out by the expense ratio. And if you were to put the loss ratio and the expense ratio together, you would get the combined ratio, which is the overall underwriting performance. So if you, and this is not inclusive of investments because the insurance company absolutely will invest the extra premiums, but for the nature of business, the insurance company all insurance companies choose not to look at investment income when it's considering its insurance market profitability. So a combined ratio would be the loss ratio plus the expense ratio. And so long as that is under 100%, meaning that for every dollar of premium coming in, that the expenses and the losses are at least 99 cents of that dollar, the insurance company is 1 cent profitable. Last year, on average, the home insurance market for the entire State of the Union, US, was 115% combined ratio. All insurance companies lost money last year by at least 15%. So this is obviously, last year was a bad year. Some years there are good years. And an insurance company operates on the realm of like 5-year, 10-year periods where they look at the total ups and downs of the market. And that's and to help them evaluate their business, they use these underwriting profitability ratios.